everyone, and welcome. We're so glad you guys could join us all today. We'll give it just another minute or two to let individuals join before we officially get started. And I guess I'll throw in some quick housekeeping items while we're waiting for everyone to join. As a reminder, this is an On24 webinar, so all attendees are currently muted. We encourage you to use the chat feature throughout the session to ask questions or share comments. And we'll also leave time at the end of the session for Q&A. So feel free to drop questions into that Q&A feature as they come up, and we'll try to address as many as we can at the end of the session. The session is also being recorded, and we will be sending a follow-up email with the recording and additional resources after the webinar. So we'll wait just another minute or two, and then Eddie will go ahead and get started.
Sounds great.
I think we'll get started at 11:02. So we'll give just people a few more seconds to join, and then we'll hop right in. We have some interesting content to deliver to you all today. I mean, I think it's interesting. I hope everyone else does too.
Yep. If not interesting, definitely important.
Yeah. And yes, there is CE for this webinar. Okay. So I think we'll go ahead and jump in, Eddie. So here we go. So again, everyone, thanks so much for joining today. Whether you've attended one of our sessions before or this is your first time, we're very glad that you're here. By way of introduction, my name is Meredith LaRoe, and I'm the Director of Compliance at Clarity Benefit Solutions. And today I'm joined by Eddie Larned, our Senior Vice President of Sales. Today we're going to be walking through non-discrimination testing, specifically across Section 125, Section 105H, and Section 129 plans. Before we get started, I do want to quickly cover the requirements of those of you joining today for continuing education. To receive your CE credit, you'll need to be in attendance for the full duration of the webinar. So that means no early departures. You'll need to actively participate throughout the sessions. We will be including 4 polling questions per credit hour, and you will need to respond to those in real time as they appear on your screen. Your attendance and participation are electronically tracked, and full participation, including poll responses, is required to receive credit. Unfortunately, note there is no partial credit if any portion is missed. And just a reminder, each attendee must be logged in individually to receive that CE credit. Okay, so with those housekeeping items covered, let's jump in. So our goal here over this session is to not make discrimination testing overly technical. It can be, but what we want this to feel as practical, usable, and directly applicable to what you're seeing with yourself and your clients.
Yeah, and I'll just add to that. I mean, you and I, Meredith, we've worked together for 15 years, and we've seen a lot of plans over the years. So I think what stands out is that most issues in this space are not because something is wildly complex. It's usually because something small got missed. So timing, documentation, classification, I think those are the things that tend to trip people up.
Yeah, that's exactly right. And so by the end of this session, we really want you all to walk away with three things. What you need to test, when you need to test, and how you can avoid the most common issues during testing.
And like Meredith said earlier, we are going to keep this interactive with a couple of polls along the way. So think of it as a bit of a stress test, not in a scary way, but just a chance to kind of step back and say, where might risk be building for our clients that we don't see yet?
Yeah, that's exactly right. So let's start with the core idea behind non-discrimination testing. At its simplest, these tests exist to make sure that benefit plans don't disproportionately favor highly compensated employees, often referred to as HCEs. The government provides tax advantages for these plans, but there's a condition. Those benefits have to be offered fairly across the workforce. So when we talk about non-discrimination testing, we're really talking about protecting the integrity of that system. If a plan starts to skew too heavily towards executives or owners, it does risk losing that tax favorable treatment.
And this is not just a theoretical risk. I mean, this happens all the time. Industry data shows that about 25% of plans fail at least one non-discrimination testing each year. So you're working with 4 clients. Obviously, statistically, one of them is likely out of compliance right now or will be at some point during the year. So this is not a rare edge case. It's a very common issue, especially as organizations grow, change ownerships, or adjust their benefits offerings. I mean, even at Clarity this year, our dependent care account failed because the only people who enrolled in it were highly compensated employees. So again, this is something that's very prevalent in the market.
And it does happen, as you can clearly see. So, when a plan fails, there are very real consequences, and they're often misunderstood. The most immediate impact is on highly compensated employees. They can lose the tax advantages that they were expecting, which means benefits that were supposed to be pre-tax suddenly become taxable income. That's not a very fun conversation to have, especially if they're owners or key stakeholders of the organization. They can create surprise tax liabilities, like I said, for executives and those key employees. And on top of that, employers may face additional reporting requirements, corrections, and administrative headaches to clean things up after the fact. And importantly, these corrections are not always simple or retroactive in any type of clean way.
Right. And that's really why we are going to emphasize this point over and over again. Non-discrimination testing is not just a compliance exercise that you check off once a year. It is a proactive, protective strategy. And when done proactively, especially mid-year, it will help you catch issues early before they become costly problems like Meredith just alluded to. So it protects the plan, it protects the employer and the employees who are relying and expecting these tax benefits. So the mindset shift we want everyone to walk away with is that testing is not optional, and it's definitely not something to delay. It is one of the more important safeguards that you have in place with these tax advantage benefits.
Yes, and I hope people do walk away with that, right? I think some people are surprised when we get into 105H testing that it's necessary and that it's required on an annual basis. I think that's something that we definitely want people to walk away with. That it's a very real compliance requirement, and it's definitely not something that you should take lightly over the course of the year.
All right, so let's do our first poll question here. There's no right or wrong answer to this question, so let's just take a quick pulse check. The question is, how confident are you that your clients' plans, or if you're in HR here, that your plans would pass non-discrimination tests today? So you can answer this as A, very confident, B, somewhat confident, C, not sure, or D, not confident at all. And please do answer these right here on the screen in the widget, as opposed to answering it in the Q&A section. Clicking it here in the widget is what's going to track your responses. And I see we've already got almost 50% of responses in. So we'll just give everyone just a second before we go ahead and look at the results.
Yeah, and this is always one of my favorite questions, Eddie, because the answers are usually all over the place. And honestly, that spread is the story.
Exactly, because the gap between somewhat confident and not sure is where most of the risk lives. I think a lot of folks just don't realize that these are required, these tests.
Yeah. And like what we'll get into a little bit later on in the session, though, is that what's interesting is that most failures aren't due to complex design issues. They're timing and documentation issues.
Yep, which means they're preventable.
Yeah.
All right, we
Where
got
are we at, Eddie?
Yeah, we're over 80% of our responses in. So let's go ahead and check out the results here.
Right.
All right, so good to see that almost 20% said very confident, but just like we said on the prior page, the risk lies between not sure and somewhat confident. So Thank you everyone for answering the question. It's always interesting to see these results come in.
It is. Thank you for responding, guys. So, as I said, discrimination testing can be complex. Our job here is to make it a little less complex. So I want to take a minute to simplify the regulatory structure, because that is where things, like I said, can start to feel overly complex, but it really doesn't have to be. At its highest level, there are two main governing bodies that you need to keep in mind. First is the IRS, who is responsible for tax qualification and non-discrimination testing requirements. In other words, they're the ones setting the rules that determine whether a plan can maintain its tax advantage status. And then we have the Department of Labor, or the DOL, operating under ERISA, which focuses more on plan governance and fiduciary responsibility. So while the IRS is asking, is this plan fair from a tax perspective? The DOL is asking, is this plan being administered properly and in the best interest of employees? Both matter, but today we are going to primarily focus on the IRS side of the equation.
Exactly. And when we zoom out on the IRS requirements, there are three key sections we're really going to focus on in today's discussion. First is Section 125, which I think a lot of folks are familiar with. That governs cafeteria plans. This is where you'll find things like flexible spending accounts, including general purpose FSAs and limited purpose FSAs, as well as premium only plans, oftentimes referred to as POPs. These plans allow employees to pay for certain benefits on a pre-tax basis, which of course is a huge advantage, but only if the plan passes non-discrimination testing. The second one is Section 105H, which applies specifically to self-funded plans. This is where we often see issues arise when employers offer richer benefits or different eligibility structures to executives or key employees. And then the third is Section 129, which covers dependent care account systems, sometimes referred to as DCAs, DCAPs, dependent care FSAs. These plans also receive favorable tax treatment. And just like the others we mentioned, they have to demonstrate that benefits are not disproportionately going to higher paid employees.
Thanks, Eddie. Yeah, so if we translate all of that into plain English, here's what it really comes down to. The IRS wants to ensure fairness, not just in who has access to the plan, but who is actually benefiting from it. So when we look at testing, we look at who can access it and who's actually benefiting from it. It's not enough to offer a plan to everyone on paper. The actual outcomes matter. If participation, contributions, or benefits are skewed towards higher earners, that's when the plan starts to fail testing. And that's an important distinction, because many employers assume that simply offering equal eligibility is enough, but the IRS is looking deeper than that. They're evaluating how the plan operates in practice, not just how it's written. So as we move through the rest of this session, please keep this principle in mind. Non-discrimination testing is ultimately about demonstrating that your plan works fairly for your entire employee population and not just those at the top.
So Meredith, I'd like to comment there real quick, just because I did see one question in the chat from Robin that said, is it the employer's fault if only highly compensated employees enroll? And I think this slide perfectly answers it. No, it's not their fault, but it is their responsibility to run the testing and make sure that the benefit is not just benefiting disproportionately those higher compensated employees. So I just saw that question. I was going to wait until the end to answer it, but I feel like this slide perfectly answers that.
Yeah, and it's not the employer's fault, but if they fail testing, it would be the employer's fault if they didn't take corrective action, right? So it's not their fault that only highly compensated people, in Eddie's case, took the DCA as his example, but it is the employer's responsibility to correct it. And some companies, and we'll talk about some corrective action later, choose to eliminate the DCA altogether. They choose to eliminate highly compensated people from the DCA. They choose to limit the maximum contribution for highly compensated people. So it's not the employer's fault that they took it, right? Certainly, but it is the employer's responsibility to correct a failure. Great question. Great tie-in, Eddie. Thanks.
Yeah, absolutely. All right, so now let's talk about one of the most important building blocks in non-discrimination testing, and that's how we define who is considered highly compensated, which actually was another question in the Q&A. So you guys are right on the ball here, and I guess our slides are as well. So for 2025, the thresholds are as follows. A highly compensated employee, or HCE, is generally someone earning $155,000 or more in the prior year. A key employee, which is a slightly different category, includes individuals earning $220,000 or more, as well as certain officers and owners. So these thresholds are set by the IRS and are adjusted periodically. So it is important to stay current each year, just as they update the FSA maximum, the 401k maximums. This falls into that category.
Yeah, and I do want to mention here, Eddie, thank you for providing this. You'll see that we said 2025. That is not a mistake. When we do discrimination testing, we're looking at prior year compensation values. So 2026 has gone up. We can share those figures with you as well. But we did mention 2025 specifically because when we do discrimination testing, it's looking at the prior 12-month period or the prior tax year. Okay, and it's not just about salary, and I think this is where things can get a little more nuanced. These classifications also includes owners of the company, even if their compensation might fall below those thresholds. You also have to account for officers depending on their role and compensation levels. And one of the most commonly overlooked areas is family attribution rules. What that means is ownership can be attributed across family members. So if a business owner's spouse or child is employed by the company, they may also be treated as a highly compensated or key employee for testing purposes, even if their individual salary wouldn't normally qualify them. I think this is one of the details that gets missed often, more often than you think, and it can significantly impact testing results.
And that, I think, is why these definitions are so critical, because they directly drive your testing outcomes, right? So every non-discrimination test is essentially comparing two groups, highly compensated employees versus non-highly compensated employees. If those groups are defined incorrectly, everything that follows, the calculations, the ratios, the conclusions, they can be off. So we often see plans fail not because of the design itself is flawed, but because the underlying employee classifications weren't updated or applied correctly. So for example, if someone crosses that compensation threshold and isn't reclassified as an HCE, your test results might look fine on paper, but would not hold up under an audit.
Yeah, that's exactly right. And that's why one of the best practices we recommend is reviewing these classifications at minimum annually, ideally before you run any testing. Compensation changes, promotions, ownership shifts, all of these can and will impact who falls into which category. So as simple as these definitions may seem, they really are the foundation of non-discrimination testing. If you get this step right, everything else in your results become much more reliable. If you get it wrong, even a well-designed plan can and will run into compliance issues.
All right, so let's do another quick pulse check here, because this is one of the most important drivers of testing outcomes. Do you track HCE and key employee status updates annually for your clients or for your own organization? So you can answer this as A, yes, every year, B, sometimes, C, rarely, D, not sure how. So similarly to the last question, we're not measuring a right or wrong. This is just a pulse check.
And I think this one is telling for sure. So let's see how the answers come in.
Yeah, and I think the reason this matters so much is because the classifications are the foundation of every test, like you said on the last slide. So if your population is off, everything that follows, like we just said, can be off as well.
Yeah, and we see this play out all the time. Company grows, someone gets promoted. Like I said, ownership changes, and those updates don't make it into the census before testing is run.
Yeah, and the tricky part is on the surface, everything looks fine, but under the hood, the plan may already be drifting out of compliance. I mean, think about all the changes that happen if a company goes through an acquisition or something and acquires a smaller company. That can totally change the number of HCEs that you have. Yeah.
So it looks like we're about 77%. You want to give the people a few more seconds to answer? Or you want to look at the result?
Let's go ahead and check out the results. We're close to 80%, so that's good by me.
Perfect.
All right. Yes, every year. Great to see that leading the way at over 36%, but still a lot of sometimes, rarely, and not sure how. So good, I guess, relevant question to ask.
Yeah. And I think this one, like I said, is pretty telling, right? If a company's not looking at their classifications every year, if the answer wasn't yes every year, there is some inherent risk in that. Even if the company ownerships don't shift or things like that, new hires, people, attrition, like all of that will feed into your classifications. So yep. Thank you guys. Okay. So we always talk about, the technical, the laws, and then we always like to bring it back to a real world example to really bring these concepts to life. So We worked with a mid-sized employer that on the surface had a fairly standard benefit structure, but during the year they experienced an ownership change. And that is where things ultimately started to shift. Along with that change, a few new executives entered the plan and some existing employees moved into higher compensation levels. From an operational standpoint, nothing seemed to be drastically different. They continued running payroll and benefits as usual. But what they didn't do was reassess how those changes impact their non-discrimination testing population.
And that's where the issue showed up. When we ran the testing, the plan had become top heavy, meaning a disproportionate share of the benefits were going to highly compensated and key employees. So as a result, the plan failed non-discrimination testing. And I think what's important here is that the failure was not due to a deliberate design issue, like, hey, only upper level managers get this benefit. It was really caused by a lack of updated classification and the monitoring after those organizational changes took place. So the plan essentially drifted out of compliance without anyone realizing it in real time.
Yeah, and thank you. And it's more common than I think people expect. In fact, about 30% of non-discrimination test failures stem from incorrect or outdated employee classifications. That includes things like I said, not capturing ownership changes, missing new HCE designations, or overlooking those family attribution rules. So the takeaway here is simple, but it's critical. Anytime there's a structural change, ownership, leadership, or compensation, you really do need to be revisiting your classifications, because even a small shift, like we had mentioned in the real world example, can have big impact on your testing results. Okay. So now let's take a step back and let's break down the core of Section 125 non-discrimination testing, because this is where some compliance issues tend to surface. There are three primary tests that cafeteria plans must pass. The first is the eligibility test. This test looks at whether the plan is available to a broad enough group of employees. Again, we're looking at who can benefit and who actually benefits. In other words, are you giving non-highly compensated employees a fair opportunity to participate, or is access effectively limited to a smaller, higher paid group? The second is the benefits and contributions test. This one goes a step further. Again, it's not just about access, but what employees actually receive in pre-tax benefit. It evaluates whether HCEs are actually getting better benefits, higher employer contributions, or more favorable options compared to other employees. And the third is the key employee concentration test. This test specifically looks at whether key employees are receiving a disproportionate share of the total plan benefits. There's a threshold here. If it's too much of the total benefit value that's going to key employees, the plan fails, even if the other two tests have passed.
Yeah, and I think what's really important to understand here is that each of these tests are measuring fairness, but they're doing it from a different angle. The eligibility test is asking who can get in. The benefits and contribution test is asking what are they getting once they're in. And the key employee concentration test is asking where is the bulk of the value actually going. So even if a plan looks compliant in one area, it can still fail in another. So for example, you might offer the plan to everyone and pass the eligibility test, but if executives are electing richer benefits or receiving higher contributions, you could still fail the benefits test.
Yeah, and that's exactly right. And that's where we can often see confusion. Employers will say, but we offer the plan to everyone, assuming that checks the compliance box. And while that is a great start, it's only one piece of the puzzle. The IRS is really focused on outcomes, not just intent. So they're looking at participation patterns, contribution levels, and how benefits are actually distributed across the workforce. And that's why it's so important and critical to run all three tests and to look at them together, not just in isolation, because passing one or two doesn't guarantee overall compliance.
So let's shift gears for a moment and talk specifically about premium only plans or POP plans, because they are incredibly common and often misunderstood. Any employer who wants to offer benefits on a pre-tax basis or allow payroll contributions to be pre-tax must have a premium only plan document. At the most basic level, it just allows employees to pay their health insurance premiums on a pre-tax basis. So why wouldn't an employer offer that? So this means it reduces the taxable income for employees and the employers save on payroll taxes. So it's a simple concept, and almost every employer offering benefits, like I said, is using this in some form. But here's the key point. Even though POP plans feel simple, they are still governed under Section 125 of the IRS tax code, which means they come with compliance requirements. And there are three foundational elements that must be in place for a POP plan to be valid. First, you need a written plan documentation. This is not optional. The IRS requires a formal signed plan document that outlines how the plan operates. Second, you need proper payroll alignment. Your payroll system has to reflect what's in the plan document. Pre-tax deductions, eligibility rules, and timing, they all need to match. And then third, you need timely amendments. If you make changes, whether it's eligibility, contribution structure, or plan design, you have to update the document accordingly within the required time frame.
Perfect. And this is where we see the majority of issues, not necessarily in the testing itself, but in the documentation and administration behind the plan. Employers often assume that because premiums are being deducted pre-tax through payroll, they automatically have a compliant POP plan in place. Without that formal documentation, the IRS does not see it that way. In fact, you can have a plan that would otherwise pass non-discrimination testing, but still be considered non-compliant because the documentation is outdated, missing, or inconsistent with how the plan is actually being run. We also see mismatches between what's written in the plan document and what's happening in payroll. For example, eligibility might be defined one way in the document, but payroll is allowing a different group entirely to participate. Or contributions are handled differently than what the plan specified.
And those gaps can create real exposure, because if the IRS determines that a POP plan isn't properly documented or administered, they can disallow the pre-tax treatment entirely. That means those premium deductions could become taxable for employees retroactively. Now you're talking about thousands and thousands of dollars of taxes that you have to claw back from employees because a plan failed.
Perfect. So the big takeaway here is that POP plans must be simple in concept, but they require discipline and execution. It's not just about running deductions through payroll. It's about making sure your documentation, your operations, and your testing are all aligned. And in many cases, tightening up documentation is one of the quickest ways to reduce compliance risk. So let's walk through a quick risk scenario that we see more often than you might expect. An employer decides to update their payroll deductions. Maybe they're adjusting employee contributions, changing plan options, or adding a new benefit mid-year. From an operational standpoint, everything seems fine. Payroll is updated, deductions are coming out correctly, and employees are enrolled in the new structure. On the surface, it looks like a smooth transition.
But here's the issue. They forgot to amend the POP plan document to reflect those changes. And under Section 125 rules, that is definitely a problem. The IRS requires that the written plan document always matches how the plan is actually being administered. So even though the payroll is running correctly, the plan is technically out of compliance because the documentation is outdated. This is exactly the kind of thing that gets flagged in an audit, because it creates a disconnect between what's written and what's actually happening in practice.
Yeah, and the impact can be significant, Eddie. In this case, the mismatch resulted in about $40,000 in taxable exposure. That means pre-tax deductions that employees thought were compliant could and were reclassified as taxable income. So the takeaway here is simple, but it's critical. Anytime you change you make a change to payroll or benefit elections, you need to ask, does our POP document reflect this? Because even small administrative updates can create large compliance risk if documentation is not kept in sync.
All right, so let's talk about timing with our third poll question here. The question is, when do you or your clients typically run non-discrimination tests? And you can answer this as A, post-open enrollment, B, mid-year and post-open enrollment, C, only when requested by a CPA or auditor, and D, we do not currently test. So we'll give everyone a couple of seconds here to go ahead and answer this. This one really matters because timing is often the difference between preventing a failure versus reacting to one, right, Meredith?
Yeah, I mean, that's totally true. The best practice is that's totally true, yeah. So let's take a few minutes to have people come in.
Yep. We're at 50%, so we'll just give everyone another 10 or 15 seconds and we'll go ahead and look at our results here. All right, we're over 70%. So why don't we go ahead and check out our results?
Okay.
All right, only post-open enrollment at 44%. But the good thing is we don't currently test is pretty low at 15%. But Meredith, with your expert opinion, what is the best practice here?
I would say would be mid-year and post-open enrollment. That is best practice. I would say a lot of clients do it only post-open enrollment, but I would say in my review, the best practice is mid-year and post-open enrollment.
Great. And thank you everyone for your participation.
Thank you. Yes. So now let's shift into section 105H, which applies specifically to self-funded health plans, including health reimbursement arrangements or HRAs. This is an area where we tend to see some of the most impactful compliance issues. Similar to section 125, 105H has its own set of non-discrimination rules, but they're a little bit more focused on how medical benefits are structured and delivered. There are two primary tests under 105H. The first is the eligibility test. This looks at whether a sufficient number of highly compensated employees are eligible to participate in the plan. It's asking, are you offering access broadly, or are you unintentionally limiting eligibility in a way that favors highly paid employees? The second is the benefits test. This one is critical. It evaluates whether the benefits themselves are the same for highly compensated employees and everyone else. That means things like deductibles, coverage levels, waiting periods, and reimbursement structures all need to be consistent.
And this is definitely where we see the biggest issue come up. It's richer executive benefits. Employers often, with good intentions, design plans that provide enhanced coverage for leadership, maybe lower deductibles, better reimbursement levels, faster eligibility. But under Section 105H, that kind of structure can quickly lead to a failure. So because the IRS isn't evaluating whether the plan seems reasonable, it's looking strictly at whether benefits are equal in practice. So even small differences can create problems. For example, offering executives a shorter waiting period, like I mentioned earlier, providing access to a richer plan tier, or carving out certain reimbursements just for leadership. All of those can trigger a failure under the benefits test. And this is something I get asked about all the time, especially with HRAs. It's like we have one medical plan and I want to give $5,000 to all of our executives and $2,500 to everyone else. Can I do that? Yes. The answer is no.
Yeah, that's exactly right. And one of the key things to understand about 105H is that it's very outcome driven. Intent doesn't really factor into the analysis here. You might design a plan thinking it's competitive or helpful for retention, but if it results in unequal benefits, it 100% will not pass testing. Another important point is that 105H often works in coordination with Section 125. So if you have a self-funded plan, like an HRA or a self-funded health plan, and you pair it with a cafeteria plan, both sets of rules need to be satisfied, as well as both sets of testing. A failure in one area can sometimes signal or contribute to issues in another.
And from a practical standpoint, I think this is why the ongoing monitoring and the mid-year tests are so important, because these issues don't always show up immediately. They develop over time as enrollment patterns shift, our plan designs evolve. So the bottom line is with 105H, the consistency is key. The more uniform your eligibility and benefit structure is across all employees, the easier it is to stay compliant and avoid those unexpected tax consequences for your highly compensated group.
Yeah, that's exactly right. Just give the same benefits to everybody, I think we see the most favorable outcomes when plans are designed equitably and fairly in that way. So again, let's walk through a real world example that highlights how quickly a Section 105H issue can develop. In this case, the employer had implemented what's often referred to as an executive carve-out. The intention was and is fairly common. They wanted to offer a more competitive, attractive benefit package to their leadership team. So what does that look like in practice? Executives were enrolled in a richer plan with lower deductibles and more favorable coverage. They also had shorter waiting periods, meaning they could access benefits sooner than the broader employee population. From a business perspective, this may have felt like a strategic decision for recruitment and retention, But from a compliance standpoint, it created a clear disparity in how benefits were structured.
And when we applied the Section 105H testing, the results were pretty straightforward. The plan failed the benefits test. Because the IRS requires that benefits be provided on a non-discriminatory basis, and in this case, they clearly were not. So the consequences were immediate and definitely meaningful. The highly compensated employees, those executives, they lost their tax exclusion on those benefits. So instead of receiving those benefits tax-free, they were then treated as taxable income. On average, that resulted in about $9,800 in additional taxable income per executive. Not a fun discussion to have with your top people. And that's the kind of outcome that really tends to get leadership's attention really quickly. What's important here is that the issue wasn't hidden or complex. The plan design itself created the failure.
Those are definitely not fun conversations to have. So I think the key takeaway from this example is timing. If the plan had been tested mid-year, the issues likely would have been identified early enough to make adjustments. That could have meant aligning benefits, adjusting eligibility, or redesigning the structure before it resulted in a full year failure. Instead, the testing happened after the fact when the only option left was dealing with the consequences. And unfortunately, that consequence was taxing your key and highly compensated employees.
Yep. And I think this leads to one of the most important principles in non-discrimination testing. The IRS evaluates the results, like we've said a couple times already, not the intent. So it doesn't matter that the employer was trying to stay competitive or reward leadership. What matters is how the plan operates in reality, who gets what, and whether that distribution is fair under the rules. So the lesson here is simple, I think. Even well-intentioned plan designs can create compliance issues if they're not tested and monitored. And honestly, I think this is where we're seeing the rise of popularity of lifestyle accounts, because those are post-tax benefits. So look, you want to discriminate, for lack of a better word, you want to attract and retain those talented leaders, give them taxable money through a lifestyle account. That's one of the workarounds. Obviously, no tax advantage.
Yep, I agree.
All right, so let's take a step back and look at some of the emerging trends in audits and enforcement that are shaping non-discrimination testing, both last year and this year in 2026. One major development is increased coordination between the IRS and the DOL. These two agencies are sharing information more efficiently, which means that discrepancies or non-compliance in benefits plans are being spotted a lot faster and easier than ever. And in addition to that, there are new audit units specifically focused on non-discrimination testing. These units are looking at all types of tax-favored plans, cafeteria plans, self-funded medical plans, and dependent care assistant plans with a much sharper lens. So even minor oversights in eligibility, contribution alignment, or documentation are more likely to trigger questions in the audit or penalties.
Yeah, and another key point here, Eddie, is that fringe benefits are also under a microscope. The IRS is paying closer attention to perks or plan features that may inadvertently favor highly compensated employees. Executive carve-outs, special reimbursement schedules, or even subtle differences in waiting periods can attract scrutiny. What's different now is the expectation of documentation. They don't just want to see if that you offer benefits fairly. They want to see proof that your administration matches your plan documents. The combination of tighter enforcement, specialized audit units, and more interagency coordination means that being proactive isn't optional. Staying ahead requires thorough documentation, mid-year testing, and regular alignment of plan operations with both Section 125 and 108 rules. In short, readiness matters more than ever before. And then one of the trends that we're also seeing is that POP documentation is now being regularly requested. It's no longer a nice to have or secondary item. Auditors expect to see a complete up-to-date plan document aligned with payroll every single time. Missing or outdated documentation is a quick way to trigger penalties, and even if your plan would otherwise pass non-discrimination testing.
So let's talk about a real-world example to illustrate that risk. The IRS requested companies' non-discrimination testing within just 10 days. The employer scrambled to collect the files, but simply could not comply in that time frame. Because they couldn't produce the requested documentation promptly, the IRS assessed a $12,000 penalty for administrative non-compliance. The key lesson here is that the problem wasn't that the plan itself was failing, it was that the employer was not audit ready. This happens more often than we might realize, and it shows why documentation discipline is just as important as the plan design or the testing outcomes. A well-documented, organized plan can help avoid unnecessary penalties, even if minor operational issues exist, because it demonstrates good faith and compliance efforts to the IRS.
Yeah, and I think that's a good point here. That brings us to kind of the closing thought for this section. Readiness matters more than perfection. You don't necessarily need like a completely flawless plan to stay compliant, but you do need updated documentation, clear testing records, and a repeatable process. Auditors will look at whether you're actively monitoring and maintaining your plan, not whether it's perfect in every single detail. The more prepared you are, the faster you can respond, the lower your exposure, and the easier it is to protect both employees and the company. That's the mindset really we want you to carry forward after this session. Proactive, organized, and ready for whatever audit or review may come your way.
And we're not talking about a huge amount of money here, Meredith. I was actually talking to one of our good partners last Thursday, and he was asking me questions about cost of non-discrimination testing and plan documents and all that. And you're usually talking with most administrators probably a couple $100 to go ahead and avoid a $12,000 penalty for administrative non-compliance. So it's not like we're talking crazy costs here to stay in compliance. It just takes that discipline that you mentioned.
Yeah, no, that's exactly right. I mean, I think the costs outweigh the potential issues, right? So yeah. A few $100s now is going to could save you thousands down the road. And also reputationally, right? It's not just the dollars of these penalties, but, failing, having to tax for highly compensated people is really not a great thing to have happen from a reputation standpoint either. So definitely those costs would outweigh any potential issues for sure. Okay, so let's talk about timing, one of the most important factors in non-discrimination testing. When you run your test, can have a huge impact on whether your test passes or fails. And it also determines how much flexibility you have to correct issues before the year ends. Best practice is to perform testing mid-year. Why mid-year? Because this gives you a real-time view of participation and benefit patterns. You can catch imbalances early, such as when a new executive is added to a plan or if an ownership change affects HCE or key employee status. Running mid-year tests can create a window to make prospective corrections, which are much simpler and safer than retroactive fixes. The second recommended testing point is post-open enrollment. After open enrollment closes, you have a complete picture of who elected benefits for the upcoming year. This allows you to verify that elections, payroll deductions, and plan administration align properly with your Section 125, Section 105H, and POP requirements.
And on the other hand, I think relying on single annual testing, say only at year end, significantly increases the risk. And I love this statistic. Studies show that plans tested only once per year have a 62% higher failure rate compared to plans tested both mid-year and post-open enrollment. So think about that. If something is out of alignment and you only test at year end, there's little you can do to correct it retroactively. And the consequences of failing a year-end test can be costly, like we talked about previously. The HCEs lose their tax advantages, the employers face potential penalties, and retroactive corrections don't fully restore the tax-favored treatment. That's a huge headache for HR.
Yeah, exactly. And I think another reason mid-year testing is so valuable is that it encourages ongoing monitoring rather than a set it and forget it approach, which we can all find ourselves getting into from time to time. It helps you catch common pitfalls like outdated census data, ownership changes, or benefit carve-outs that may unintentionally favor highly paid employees. By testing twice a year, you can make small targeted adjustments instead of large-scale corrections at the end of the year. that approach not only reduces compliance risk, but also gives peace of mind to both HR teams and leadership.
Absolutely. So I think the takeaway here is kind of simple. Mid-year plus open enrollment testing equals prevention. Single testing is reactive, double testing is proactive. Proactive testing is going to reduce failures, avoid costly corrections, and ensure that the plan remains fair and compliant throughout the year. Ultimately, timing is not just a technical requirement, it's strategic, right? It's a strategic tool for protecting both employees and the employer.
Yep, exactly. And so let's talk briefly about correcting non-discrimination testing failures, because they can and will happen. One of the biggest misconceptions we see is that retroactive fixes, like trying to adjust contributions after the year is over, generally don't work or are not even allowed. The IRS is very clear. They want prospective corrections, meaning adjustments that apply going forward, not after the fact.
So what are the practical tools for fixing issues when a test fails? First is going to be contribution adjustments. You can increase contributions for non-highly compensated employees or adjust allocations to restore balance. So we've had some scenarios where we said, okay, highly compensated employees, instead of the max election for a dependent care account of 7,500, you're capped at 3,500, and that can restore that balance. Second, plan redesign. Sometimes eligibility rules, waiting periods, or benefit tiers need to be realigned to pass the test. And then finally, retesting. Once adjustments are made, you need to run the test again, confirm that the fix actually worked. The key point is that corrections are not just a one-time action. They're a process that ensures the plan remains compliant and protects tax-favored treatment for all employees.
Perfect. Exactly right.
All right, we're coming down to the end here. So I think we've got our last poll question, which is, if a plan fails testing, what's your first step? So you can answer this as adjust elections, amend the plan prospectively, C, retest and monitor, or D, not sure.
And I think this is a really important question, Eddie, because it gets to how you think about compliance.
Yeah, and I think we typically see a good mixture of answers here. I think a lot of these are good answers, but I guess we're going to pick what we feel is the best answer.
Yeah, and I think all of them are good.
Yeah,
honestly.
Yep.
And all have to be done. It's just, what is the first one?
Right. So we're over 50% of answers in. Let's just give another few seconds, try to get up to 70%, and then we'll talk about the right answer.
I think we're just about at 70%, Eddie. Let's go to the results.
All right, good mixture of results. Like we said, there are a lot of good answers. I think the answer we had was adjust elections is a good place to start. Kind of like I gave the example on the last page, last slide, of kind of rebalancing the contribution amount. So I think amend plan prospectively is also a very, very strong answer. So very good responses here.
Yep. And most discrimination testing, once you do it, will tell you how to adjust the elections in the case of a failure. So that should be really the first thing you do, because that will immediately adjust those outcomes. So we are going to say adjust elections, but all of these are relevant and important in making sure that your plan is corrected moving forward. So thank you for your participation. Okay, so let's shift focus to documentation. We're nearing the end of our session here, because even the best design plans can run into trouble without proper record keeping. A solid documentation system isn't just a nice to have, it's essential for passing audits and proving compliance. So here's a checklist of key items that every employer should maintain. First, the employee census. This is your foundation. It lists every participant, their compensation, their status as an HCE or a key employee, and other relevant classifications. Without an accurate census, any testing is unreliable, and you risk failing non-discrimination tests, even if your plan is structured correctly. Second is your testing results. Keep a record of all mid-year and year-end non-discrimination testing results. Include the date the test was run, the methodology used, and any follow-up corrections or adjustments that were made. These documents show auditors that you're actively monitoring compliance, not just hoping the plan passes. Third, your plan documents. This includes POP plan documents, Section 125 plan descriptions, Section 105H plan terms, and any amendments. Make sure that they're up to date and reflect what's actually being administered in payroll and benefits. Finally, a retention schedule of at least 3 years. While some employers keep records for longer, the IRS generally expects a minimum of 3 years of record keeping. Longer retention can be helpful, especially for mid-year testing records and prior year corrections.
So a practical question, I think, to ask yourself when evaluating your documentation: could you produce all of this within 7 days if the IRS or the DOL requested it? And if the answer is no, that is definitely a red flag, kind of like the incident or example we gave earlier. Auditors are increasingly expecting rapid response times, and delays can trigger penalties. Like we talked about, that $12,000 penalty, even if your plan passes the test themselves. They're so reasonable, the IRS. So think of documentation as your first line of defense. Accurate, organized records demonstrate diligence, reduce risk of fines, and give confidence to HR, leadership, and employees that the plan is fair and compliant.
Yep, and remember, documentation isn't just about compliance. Again, it's about readiness and peace of mind. When everything's organized and accessible, audits become more manageable instead of being a complete crisis.
Yeah, so the takeaway here: maintain your census, testing results, and plan documents, follow a consistent retention schedule, and make sure you could produce everything quickly. That is how you're going to turn documentation into a strategic compliance tool as opposed to a liability. All right, so just to wrap us up these last couple of slides, let's talk about the top 3 mistakes we see employers making with non-discrimination testing. First is skipping the mid-year testing, like we talked about, with that 62% higher risk of failure. Many employers are relying solely on year-end testing, thinking that one test is enough. But without the mid-year check, small changes like new executive hire, ownership transition, or unexpected employee elections can push the plan out of compliance before year end. As I just mentioned a second ago, plans tested only once annually have a 62% higher risk of failure. The second major mistake is POP document misalignment. So even if payroll is processing correctly, your plan document has to match what is actually being administered. Missing updates, outdated signatures, or mismatch effective dates can create exposure, even if the testing itself is fine. And third is ignoring ownership or officer changes. Changes in ownership or key personnel can dramatically shift your HCE, your highly compensated employee, or key employee population. So if these changes are not reflected in your census or plan administration, your plan could fail unexpectedly.
Yep. And just to illustrate this, I'm going to just quickly go through a real-world example. An employer had a POP plan that passed all testing, eligibility, benefits, and key employee concentration looked fine, but the plan document had the wrong plan year listed. Because of the administrative mismatch, the IRS assessed a $5,000 penalty, even though the actual plan operation was compliant. This shows that passing tests alone isn't enough. The IRS and DOL are increasingly looking at documentation integrity as a separate compliance factor. Payroll alignment, plan years, and properly executed amendments all matter, and small oversights can carry real financial consequences.
So I think the big takeaway is that non-discrimination compliance is multi-layered. It's not just about the testing. It's about testing, documentation, and population management working together. So avoid these top 3 mistakes and you dramatically reduce the risk. So test mid-year, not just year-end. Keep your POP and plan documents aligned with actual administration, and update your census and plan records whenever ownership or officer changes occur.
Yeah, and treat discrimination testing like a continual process, not just a check the box type of thing. That approach, again, keeps both employees and employers protected and ensures audit readiness at all times. So as we wrap up, I'm going to try to get through this so we can have some time for questions. Let's reinforce the 3 pillars of non-discrimination testing compliance that will help your plan stay both fair and IRS ready. First, align plan design and documentation. Second, test early and often. And 3, maintain strong documentation. So go ahead.
So, yeah, put together, I think these three pillars create a proactive approach as opposed to reactive. When you test, align, and document, you're not just avoiding penalties, you're protecting the tax advantage status of your plans and providing fairness to all employees. So think of non-discrimination testing, as Meredith said, as an ongoing process, not just a one-year event.
Yeah, and ensure align your design, test early and often, and keep your documentation strong. These steps turn what can feel like a complex regulatory requirement into a manageable, repeatable process that reduces risk and builds trust ultimately. Okay, so I think we're going to go ahead, and we only have about 5 minutes left. So I think we'll go ahead and open this up to questions. So let's see. We have quite a few. So we only have 5 minutes left in this session, but if we don't get to your questions, we do take them all back and we do provide responses. You will also get a copy of this recording as well as the slide deck after the session. So question is, how often does this compliance fall on brokers versus payroll providers? So I think that's a good question. And I think it depends, right? So we have to determine, right, who's ultimately responsible for what. Is it the third party? Is it the payroll company? Is it the broker? And it really comes down to asking those questions to determine who's doing what, right, from a compliance standpoint. It may not necessarily be the broker, but we can't just assume that it's also the TPA or the payroll provider. So asking those questions and make sure you're checking that checkbox that says, okay, the payroll company is going to provide the plan document, the TPA is going to do the discrimination testing, the broker is going to make sure everything is coordinated, is really important. Don't just assume somebody's doing something when they're actually not. Make sure you ask those questions to determine who ultimately is doing what.
I totally agree with that, Meredith. I think too often we do assume, and I'm always actually surprised by this, but you assume that the payroll company, because the tax advantage is kind of a function of payroll, or at least that's where it's set up, you assume that they're going to prepare it for you, but that's not always the case. So I think that's something to be aware of. I see a really good question in here, Meredith, from David. He lays out this whole scenario, but I think the crux of the question is, can a group that doesn't have a POP plan go back and put one in retroactively? Is that allowed?
No, it is not. No, it always has to be, again, it always has to be prospective, right? So in order for a plan to be formally adopted, there has to be a written plan document, it has to be executed, and it has to be on a prospective basis. So the short answer here is no. It has to always be prospective.
I see another good question in here. Does this apply to groups of all sizes? What if the group only has 2 employees?
It does. It applies to groups of all sizes, which sometimes surprises people. It could be a group of 2. It can be a group of 1 million. Discrimination testing does apply. And Connie also asked a great question about, is it required for all business entities like C Corp, S Corp, LLC? The answer is also yes there.
I also see a question from Amber in here. Remind me, does Clarity offer testing services? And if so, what information do you need to produce a quote? Yes, Clarity does administer non-discrimination testing. We do write plan documents for Section 125, for FSA, for dependent care. So feel free to reach out to your local sales rep, and we will also have them follow up with you after this call if there were any questions that we were not able to answer. And we can absolutely provide you with a compliance checklist, frequently asked questions on these benefits, anything that you need to make sure your organization and your clients' organizations are protected and in compliance.
Yeah, I think we have time for one more question before we wrap up. So Barbara asks, curious how the amount of the penalty is typically determined, plan size or something else. Well, I'm not the IRS and I cannot speak to that. I would say there's a few things that they look at, probably group size, probably number of impacted individuals, how long the error has been going on and hasn't been corrected or addressed. And they probably will look not so well upon repeat offenders, right? So maybe groups that have had DOL complaints in the past or have clearly failed testing in the past. So I think there's a lot of things that would play into how the IRS or DOL is determining penalty. That's not just group size. I think there's other factors that go into it as well. So I I wanted to thank you all for your time today and your thoughtful questions. If we were not able to get to yours, like I said, we will follow up individually after this webinar. We'll be sending a follow-up email with the recording, as well as a copy of the slides, and we'll also follow up separately with your SHRM and CE credit information.
Thank you so much, everyone. We appreciate the time. Thanks for spending the last hour with us. Tons of great questions. We promise we'll be following up on any we didn't get to address. Thank you so much.
Thanks, guys. Have a great day.